Thank you very much, and I tell you, I'm so delighted to be speaking in a building like this. I think it's the most beautiful building I've ever spoken in. It's really nice, and it's a pleasure to be here, of course. It's been about 3 years since I've been in Budapest, and it's as beautiful as ever. What I'd like to do today, by the way, that's a very interesting motto, be greedy when others are fearful. You know who, I didn't say that. That was said by another successful fund manager. But it's very, very true. We have to be ready to buy when others are selling. But what I'd like to do today is give you a little background on emerging markets. The key, of course, is change. One of the most impressive things that you can say about emerging markets is that they've been changing, and very rapidly. If you look at Shanghai, 25 years ago, I was there in Shanghai on the Bund, you know, the old banking section. It looked like this. Today, it looks like this. It's an incredible change that have taken place. If you look at what Dubai was 25 years ago, this is what it looked like. And by the way, we had a little office way in the background there. You see one of the towers, the 3 towers. The one in the distance, we had an office there, and we were, after we set up an office there, we were wondering, what are we doing here? This is a desert. Today, it looks like this. Incredible development, and of course, the tallest building in the world. I don't know if any of you have been to Dubai. You must go there and stay at the Address Hotel, which overlooks this building, and below it, there's an incredible fountain, which is bigger than the one in Las Vegas, 3 times bigger than the one in Las Vegas. And every half an hour they play music and have this incredible water show. Kuala Lumpur looked like this 25 years ago. I stayed in one of those little hotels there when I visited, and today it looks like this. And by the way, those 2 towers used to be the tallest in the world, and Mr. Mahathir, who is now again Prime Minister of Malaysia, was so proud that Malaysia had the tallest buildings in the world. And then, of course, the Dubai Tower was built, and someone said, Mr. Mahathir, you're no longer the biggest. He said, yeah, but we got 2. So, emerging markets in 1987 was like this. We had started the very first emerging markets fund listed on the New York Stock Exchange. In those days, we had 6 markets in which to invest. Mexico, Hong Kong, Philippines, Thailand, Malaysia, and Indonesia. That was it. All the other markets were closed. Of course, Budapest was still in the East. There's no way we could invest in all of the Eastern European countries. Couldn't invest in Russia, China, you name it. You could go around the world and couldn't invest. Today, we are now in this situation where we have over 70 markets around the world. And of course, it speaks to the fact that the CFA now is in places like Nigeria and other parts of the emerging markets world, which means that you've had an incredible upsurgence of interest in capital markets. Why are we in emerging markets in the first place? And of course, the key word there is growth. Because if you look at the growth of developed markets compared to emerging markets, the 2019 forecast is about 4.5% for developed and about 1.6% for emerging and 1.6% for the developed. So you see an incredible difference between the developed and emerging world, very big difference. And it's not only China, by the way, it's other countries around the world that are growing pretty fast. And of course, the other thing is size. Emerging markets are becoming much more important in the world. If you look at the most populated countries, of course, China and India, over 1 billion people. Then the United States comes 3rd, about 300 million. Indonesia, Brazil, Pakistan, Nigeria, Bangladesh, Russia are all bigger than Japan. So you have an incredible market opportunity in these countries. And if you look at percent of the world, population 70+%, foreign exchange and gold reserves 63%, land mass about 50%, exports 42%, and GDP in US dollars about 42% of the world, and growing, as you know. Risk. Of course, a lot of people ask me about, isn't risky in emerging markets? And it's true, there's a lot of risk. But let's look at the facts. If you look at private sector debt as a percent of GDP, yes, China is right up there with Canada, but look at the other countries, Brazil, Russia, India, South Africa, much, much lower than Canada, the US, and the UK. If you look at government debt, Brazil is the highest, but even Brazil is lower than the United States, and the other countries, Russia, India, China, and South Africa, are lower than the developed countries. So if you look at risk from that point of view, it's not too bad. Many of these countries are in good shape. And more importantly, you know, one of the first questions we ask when we go into a country is, okay, we can go in, but can we get out? And of course, you have to look at foreign reserves. And if you look at the foreign reserves as a percent of GDP, Brazil, Russia, India, China, South Africa, all have more foreign reserves as a percent of GDP than Canada, the United States, and the UK. One of the biggest factors that we've seen that have really hit emerging markets in a big way is technology, because what's happened is that you've seen a sort of a leapfrogging where they go from nothing to the best technology. Look at all these red bars. Brazil, 138 million, India, 483 million, and so forth and so on. This has an incredible impact because nowadays, you know, the old Nokia phones are gone. Now it's Huawei, it's Apple, it's smartphones, and that has an incredible impact. I don't know if you've been following what's happening in Hong Kong. I was there yesterday. I went to Hong Kong and Macau, and the demonstrations continue. Why? How can these kids get together, thousands and thousands of people on the streets? Because of cell phones. You know, they're used to playing multiplayer games, so they can cooperate with each other without having a leader. So this is having an incredible impact politically and economically. India, smartphones are going down. Average cost is now going to 50 and less. So you can see the proliferation of smartphones around the world in places like India where, you know, over 1 billion people. Interestingly enough, if you look at the cryptocurrency world, I'm not believing in cryptocurrencies yet, but maybe I will in the future. But you can look at these red bars, how common they are in different countries, and emerging markets are at the top. Turkey, Colombia, Brazil, South Africa, Argentina, Mexico, Indonesia. Very high use of cryptocurrencies. How can they do that? Well, because they've got the smartphones. And many of them don't have bank accounts. AI, artificial intelligence. Who are the leaders? Of course, the US is right up there, but look who's second and third. China and India, Israel, and then Germany. So this is, again, having a very, very big impact on these countries. Of course, we're interested in value, and we want to buy cheap stocks, stocks that are going to give good value and go up in price. And if you look at the price-earnings ratios of emerging versus developed markets, you'll see developed markets are more expensive on the average. If you look at price to book, again, emerging markets are cheaper. And if you look at currencies, we find that these currencies are very, very cheap now. You've seen an incredible decline in the value of emerging market currencies. This is the currency index. And you'll see that we've seen, you know, up to now, we've gone from 107,000 to something like 57,000. And some of these currencies have declined by over 90%. In the case of Argentina, the peso has gone by 95%, Turkish lira down by 80%, Brazilian real by 62%, Russian ruble by 58%, and so forth. Now, of course, a lot of people say, hey, I don't want to go into these countries because the currency is getting so bad. But look at it the other way. A cheap currency means opportunity for many companies because they can export. They can do a lot of things with a lower price currency. So we are finding lots of opportunities in those countries, particularly those that have weak currencies, because we're buying in US dollars and picking up these stocks in US dollar terms very, very cheaply. ESG, this is the new buzzword in the emerging markets world and in the developed markets world, as you know. We've just written a book called Invest for Good. I hope you all buy it. It's just not an advertisement for us, but anyway, I think you'll find it interesting because it tells about some of the experiences we've had in ESG. But if you look at the reason why we should be invested in ESG-oriented companies, is this, simply that they perform better. If you look at the MSCI ESG Leaders Index, you know, the MSCI, Sustainalytics, and a number of organizations are doing studies of companies, of how they're doing in ESG. They're scoring them. The leading companies perform better than the regular index. So that alone is a good reason for us to be interested in ESG, despite the fact that we're also looking at the risks of not being in ESG. And if you look at ESG strategies in terms of the amount of money going into ESG-oriented companies, you'll see it's going up. A month ago, I was in the US talking to institutional investors, and almost everyone asked the question, what are you doing in ESG? What about the environmental, social, and governance factors? So more and more money is going into these kinds of companies. Performance. A survey was recently done by State Street Global Advisors, and they asked institutional fund managers about how do you anticipate your institution will alter its allocations to the following categories. And they asked about North American equities, Asia-Pacific equities, European equities, and emerging market equities. And you can see the green is the increased allocation. The largest increase in allocation was for emerging markets. And if you look at the question, my institution would benefit from greater exposure to emerging markets, 57%, the larger percent, said agree. So we believe there's going to be a lot more money going into these emerging countries. And if you look at the performance, by the way, the last 10 years has not been great for emerging markets because the US market has been so good. But if you look at the recent performance, this is the short-term performance since September 18. You can see emerging markets in red are outperforming. And taking the long-term view from the very, very beginning when the index was formulated, you'll see that emerging markets returned about 441% versus about 151% for developed countries. So we're still in a very, very good position. Thank you very much.
Thank you, Dr. Mobius. And now, after the presentation of Dr. Mobius, we are going to have a one-on-one stage discussion between Dr. Mobius and Tamás Pletcher, the equity analyst of oil and gas industry at Erste Bank Investment. It's time to start. Thank you.
Yeah, Dr. Mobius, thank you very much. It was a really fascinating presentation. I really liked it. My first question would be regarding one of the topics you mentioned already in this presentation, that's China and Far East. You are pretty close now to the events. What do you think? Can China survive the next couple of years without a crisis? We heard from Gary Baker on his speech that the financial world is not without crisis, and China has not experienced anything in the last 15, 20 years. What do you think? Can China go ahead, or do they have to do something else?
China won't experience the kind of crisis the US had during the subprime or any of the other crises, simply because the most critical parts of the Chinese economy are in the government hands, in the hands of the Communist Party. So if you look at the major banks, it's as if Citibank, JP Morgan Chase and so forth were owned by the US government. China owns all those banks in China, the big banks. So that's number one. Number two, the Chinese have been extremely cautious regarding their currency, control of their currency. They're very strict currency controls. And by the way, the Chinese mentality in that regard is quite universal. I spent a lot of time in Taiwan, and of course there they did the same thing. They watched the foreign exchange very, very carefully. They gathered as much of foreign exchange as possible. They controlled the currency very tightly, and that's the same thing with China. The third thing you've got to remember is that in addition to controlling the banks and the foreign exchange, the major companies are controlled by the government. Now, of course, they're listed. You know, you can buy some of the, like, for example, China Life Insurance Company, you can buy on the stock exchange, but at the end of the day, it's controlled by the government, by the Communist Party. So there's no way you're going to get the experience that you have in the US, where there's, you know, real breakdown of all systems, and the government has to take emergency measures and so forth and so on. However, there's no question there's been excesses within the Chinese system. For example, the Chinese banks, in an effort to increase their lending and increase their business, started issuing so-called trusts, which were basically investment funds, private equity funds, basically. And they were issuing these shares to people, and people thought, well, if it's issued by one of the banks, I'm going to be okay. It wasn't okay, and some of these trusts were in trouble. So the government stepped in and said, look, you've got to start buying back these trust shares so that people are not going to be lining up in front of the bank and creating problems. So there's no question that you've had these issues, and a lot of the provinces are in trouble. They spend too much. You have the so-called ghost cities, a lot of building. See, the reason is that the Communist Party says to a provincial governor, look, you've got to have 8% growth in your province. Okay, that's the order. I'm going to go out and spend. And the banks have to lend to them because they're in the orders too to lend. So now the Chinese government is beginning to pull back on that. So I think they're going to be able to you know, not go through the kind of crisis that we would expect. However, you can still lose money in China, so you got to be careful. No question. Some companies will go bankrupt, but it won't be an overall crisis.
I see. What kind of asset classes or markets do you like at the moment the most? I remember a few months ago you were very bullish on gold, and this was working quite well. I was also watching your presentation, you mentioned ESG, which might be a kind of a topic. I know from my company, we have one fund, which is a kind of an environmental protection fund. It hasn't done a real good performance of the last few years, but this year, that was by far the best investment. So do you see any topics, any markets, what you especially like in this environment?
Well, let me say about gold. I was talking about gold as sort of a safety measure, and I recommended that people have maybe 10% of their assets in gold. Simply because the proliferation of money supply around the world is getting completely out of control. You know, the central banks, for some reason, think that by pumping money into the system, they can create inflation. And it can't be done. The reality is that we are in a deflationary world. Because of technology, things are getting cheaper. They're not getting expensive. And in fact, I've just written a book on this, the inflation myth. Because you know, we're in a situation where central banks are using the wrong measure to begin with and taking the wrong action. The other thing is cryptocurrencies. The proliferation of cryptocurrencies means that how much money is out there? How much currency is out there? So what is the ultimate measure in terms of currency? It's gold. Gold is probably the best thing to hold on when you have this proliferation. So that's the reason why I mentioned gold. In terms of other sectors, I'm most interested in consumer-oriented companies, simply because per capita incomes are going up globally. particularly in emerging markets. The per capita incomes are moving up at a very fast pace. And if you look at the number of people, as I mentioned, China, 1 billion people, India, 1 billion people, if you can capture some of that consumer market growth, then you can do quite well. Now, when I mention that, I also mention that you've got to get consumer-oriented companies that are into the internet as well. I'm not recommending Amazon, I'm not recommending Huawei or any of these other companies, but I'm recommending companies that are old-style consumer companies that are grasping the internet methodology so that they can market their goods in another direction.
Just one follow-up on your comments on deflationary environment. Does it also mean that do you expect the current low interest rate environment globally to remain for a sustainable future?
Well, it looks that way. I mean, central banks have seem to be continuing to follow the same methodology. You can see what's happened with the ECB. They're in negative territory now. The US could go into negative territory as well. Because you must remember that Trump is telling the central bankers they're not lowering enough, and eventually that message may get through and the US will continue to go down. You must remember now, we have a global contest not only to create inflation, because the central bankers have the theory, I can't remember the name of the economist, but some economist said, look, if you want growth, you've got to have 2% inflation. So everybody's fighting for 2% inflation. They're not getting there, but they continue to print money in order to get that. But then the other side of it is that you've got a situation where people are beginning to pick up on the fact that you've got, I mean, leaders are picking up on the fact that in order to be successful with foreign exchange reserves and trade, you've got to devalue your currency, which is why the US keeps on accusing China of currency manipulation. The problem is the US is in a very difficult position because unlike the Chinese, they cannot control their currency. It's a global currency. It's very difficult to do that unless they lower interest rates to negative territory to equal that of the EU, that maybe people will begin to abandon the US dollar. But that's going to be a very, very momentous occasion when that happens.
I see. Sometimes it seems to me that you prefer some of these conditions or some of the issues which are in China, you know, which are more preferable about that in the US. I mean, you know, the tools what the Chinese government has on the development of the economy. It's quite strange, you know, to hear that, because we always heard or we always believed that market forces are the ones which lead to the best equilibrium.
We're now in a real battle between two philosophies, and it's very exemplified by what's happening between China and the US. The US is saying we've got to have a market economy where the government does not get involved in controlling everything, that the private sector determines the allocation of capital. The Chinese are saying no. There should be a political leadership, there should be one party. We will adopt a market economy to allocate capital, but at the end of the day, the government must be in control. And they point to Singapore. Singapore is a one-party state, very successful, where they've said, look, there'll be one party, but we will have a market economy. And more countries around the world are beginning to look at this contest and beginning to think, or at least ask the question, which is better? Should we go the Chinese, Singapore way, or should we go the US way? And I think Europe, by the way, has that conflict, because I think the people in Brussels would like to feel that they can control everything, but that you can allow a market economy to reverberate around the European community. So it's a real battle of philosophies that you're seeing, and unfortunately it could turn into something more serious, because the Chinese have become much more powerful. They've expanded into the South China Sea. They have the Belt and Road projects to project themselves into Europe and Latin America and other places. So I think we have to watch that. I think it's going to be a very important development as we go forward.
Yeah, we try to capture the best of both philosophies, I suppose. Can you share your view about our region? I mean, EMEA, and particularly Central and Eastern Europe and Hungary. What do you see? What are the key problems here? What are the key issues to be solved? And from investment point of view, what kind of opportunities do you see here?
I think what I just mentioned is one of the key issues for Europe and Eastern Europe in general. Another, deciding the role of government and how you're going to, how much you're going to allow the market to operate. But the other issue for Eastern Europe now is, of course, what's happening in China, in Asia, and how they can project their expertise, their knowledge, their products into these emerging countries, because that's where the market is going to be in the future. And also, I think one of the problems facing Eastern Europe is the requirement by Brussels to control a little bit too much. In other words, controlling too much of the smaller parts of the economy. And I think that's the reason why you have Brexit, because the British were not willing to allow Brussels to control more and more of the economy. And I think the Eastern Europeans have the same challenge facing them. But the bottom line is Eastern Europe has a better potential to grow than Western Europe. That's where the growth could come going forward, provided that the Eastern Europeans really allow the private sector to move and grow at a fast pace.
I see. Another topic which I'm very curious about is those changes we have seen in the investment markets and we have seen in the investment area. In the last few years, we saw that passive investments, ETFs, high-frequency trade are gaining market, while active investment management is losing, which is actually very bad for me personally, who is actually serving the active fund managers. Do you see this trend to continue, and do you see any changes in this trend? Can something, break this kind of change what we have seen in the last few years?
The trends are continuing, and in fact, just last week, or a few weeks ago, the amount of money in passive funds, ETFs and index funds, surpassed that of active. And the trend continues. If you look at the flows of funds, more money is going into passive ETFs. And one of the key reasons is that it's about cost. It's cheaper. You know, the management costs are lower. However, we're now hearing from institutional investors around the world that they need to have an alternative to the passive, because many of them are up to their neck in passive funds. And they realize it's a danger, because you're basically following the crowd. So many of them saying, look, we need something that's active, but truly active. See, this is the problem, and one of the reasons why we decided to start our own firm is we found that in being part of a large organization, running a huge fund, you more or less had to follow the index. There was really no much choice. And you try to be as active as possible, but it's very difficult. So I think there's going to be an increasing demand for active, truly active, and also because there is this emphasis on ESG. In other words, being more activist in improving governance. And our emphasis in our firm, for example, is on the governance side. We say, look, let's go to companies and see if we can improve governance, and then we can go after the social and environmental issues. So I believe that there will still be a role for truly active managers, but they're going to have to behave in a much different way than in the past.
And I suppose you have to also show that you can consequently have higher returns than these passive investments. Am I correct with these assumptions?
Of course, at the end of the day, you've got to have good returns. But what I found among institutional investors is that they're willing to be patient. Recently, when I traveled to the US, particularly among family offices, it's interesting, they said, I remember them asking, now, in your portfolio, how many stocks do you plan to have? And we said, well, about 25. They said, so many? I said, what? What do you mean? He said, we have one manager that has 5 stocks. In other words, they said, we want concentration. We want more active management. And at the end of the day, we believe that over a 5-year period, that can outperform. By the way, recently I was visited by a colleague who has a fund, emerging markets fund, and they're more active, you know, very much involved. And I asked him, you know, I'd be interested in buying your fund. And I asked him, what is your management fee? 190 basis points. 190 basis points plus a performance fee. But I'm willing to buy it because I know that he's going to be really active and he has a chance of really doing quite well. But you can see the tremendous gap. When you have 190 basis points, ETF is maybe 10 basis points or whatever.
I see. And my last question, we have a lot of young talents in this room. What kind of an advice can you give us through your career to be a good investor, to be successful in this industry, and to have a good career like you?
I think the advice that we heard in the first address was very, very good, and that is being curious, being open-minded, being ready, always ready to learn. This is very, very important. You've got to be humble, you've got to be willing to accept new ideas, and constantly learning. I mean, I'm basically a perennial student. This is really the key, I believe.
Okay. Dr. Mobius, thank you very much for the presentation and for the talk.
Thank you very much.
And wish you a good day. Thank you.